welcome to the Jimmy Real Estate TV show. It's been a while now, but I have Feliks Gitsin from Fork Funding once again. He was here. He was here back in, I think, September, even it might have been August actually. Yeah, August when rates were around 5% or reaching over 5% at the time, and now rates are averaging around 7.
According to Mortgage News Daily, they're over 7%, but the market is changing and we are in a different time, and I think it's a great time to be in.
Okay, so why do you think it's a great time?
Well, the market has completely shifted. It used to be a seller's market. Buyers were getting into the market sight unseen. They were literally making offers above asking price. They were going into properties, waiving inspections, appraisals. It was crazy. Now the market has completely shifted. It's now officially a buyer's market. The inventory is starting to increase, and buyers can get deals. Now it's one of the best times to be a buyer agent because you could actually negotiate. You could have discounts on the pricing. You could have sellers pay your closing costs. It's a great time to be in the market if you're willing to get into it. Get a house that's used to be a lot more expensive for a little bit less. And as long as you could afford the mortgage payments, you could always refinance.
Yeah, so, that you're bringing up the refinance because a lot of people are mentioning it. So we are expecting the interest rates to go back down in like a few years, I guess, for people to refinance.
Market experts are indicating that once inflation is tamed a little bit, rates are going to go down, especially because there's going to be a recession. I think the other day on Bloomberg, one of the big CEOs of one of the investment bankers said that there's going to be a recession. It's 100% at this point. That's what the forecasts project. So when the recession happens, and people are saying next year, eventually the way to get out of recession is back to freeing up the money supply. So the Fed's going to start pumping money back into the system. Mm-hmm. Rates are going to go down. I can't tell you that's going to happen in a year, but there's a horizon that's relatively soon on a 30-year mortgage scale that you're going to be able to get a better deal on your mortgage. So you buy the house, you date your mortgage, you don't marry it.
Gotcha. Okay. And then in terms of, this another thing that I've been hearing about, it's an ARM, like a 10-year ARM, I believe, or 5-year ARM. Is it something that you guys recommend these days because the rates are low? So
when the rates were in the 2s, did not make sense to take an adjustable rate mortgage because the rates were literally at historical lows. Why would you take an adjustable rate for it to adjust in the future? If you're at the low, chances are it's going to adjust higher. Right now, the rates are the highest they've been since 2002. Mm-hmm. So we're talking about rates that have the ability to go down. And if people are going to refinance, the average mortgage is 4 to 7 years. That's the duration of the mortgage. People either sell, they refinance, they do something. So if you're going to refinance eventually or sell your property eventually, then it's a good idea for you to have a big rate discount by taking an adjustable rate mortgage. Now, that's a misnomer because it's not really adjustable until after the fixed rate period. So what that means is like a 10-year ARM, that's a term you just threw out there. That means the first 10 out of 30 years are fixed. So year 1 through 10, it's a normal fixed rate. Mm-hmm. After year 10, it'll adjust. But right now, we have local lenders where most mortgage rates are probably bordering around 7. We have local lenders with adjustable rates that start in the mid-5s for well-qualified buyers. Now, rates can change on a daily basis. So the best way is to really find a local mortgage specialist that has access to these community banks, mm-hmm. and see what the best quote that they could give you. Because you're going to see a large savings between the fixed rate mortgages and the ARMs. And mostly because just like buyers, banks are a little bit scared of locking in for a 30-year term.
Gotcha.
So they want the buyer to have a little bit of that risk, and therefore they're giving him a discount for it. But in the grand scheme of things, I think it's a good deal for a buyer, especially one that maybe has young kids that they want to move into a school zone. The kids in 10 years probably be outside of the school system, and they'll move out. Somebody that's not going to keep a house for that long, it's a great idea.
Okay, and then for the 5-year, do you recommend like 5 years to people now, or even the 10 years? Because people keep mentioning how they're gonna refinance after after once the rates go back down, they'll refinance their adjustable rate mortgages that they have. But aren't there any penalties or anything like that?
So the 5-year scares the crap out of me. And
Okay.
the reason being is I've been here in the mortgage space for quite a while. I was present in the mortgage space when 2008 happened. I was here before that. And the adjustable rate, if rates don't go down in the next 5 years, can mean somebody could potentially lose their house. Okay, because it could adjust a lot. Mm-hmm. I would like that duration to be a little bit longer. So for me personally, because I'm more conservative and I've been doing this quite a while, I usually recommend at the very least the 7, but usually the 10. The 10 is my idea of a sweet spot.
Okay.
It's a long enough fixed rate period where customers are protected and their backs aren't against the wall where they have time to make a decision. Because 5 years, while it seems like a lot, it really isn't. Especially when you're buying a house, renovating and moving in, but you're turning around and all of a sudden years have gone by, you're in year 4, and guess what? You can't wait till the last minute, you have to make a decision. That's why I recommend the 10-year. In terms of adjusting, it will, but if you find a nice time in between when you can refinance, you can. There's no prepayment penalties on the loans that we do. Okay. So you could pay it off anytime with no penalty. You could pay it off quicker. And you could also refinance anytime because there's no prepayment penalties. So now the ball's in your court. As a consumer, you have a vehicle that gives you a significant discount and you're able to get a house more affordably. In this market, when housing is starting to come down, you can get a deal. And yes, your payments can be higher than it was before because the rates are up. Mm-hmm. But as long as you could afford that payment comfortably for now, there should be an opportunity for you to be able to lower that payment in the near future.
Well, that's pretty good then, if that's the case, because I think a lot of people should be doing it, especially with 10 years. I do think within 10 years rates would go back down, but if they don't, then...
Oh, listen, if the customer, keep in mind, if they don't, it's not like your mortgage is going to triple, right? Mm-hmm. The mortgage will potentially go up, but you plan for that, right? You can't go into this thing thinking that, oh, well, the rates are going to be 2% again. They're not. They're not going to be 2% again. We do expect rates to come down. If they come down within the 10-year cycle, you're protected. Even if they don't, right, there's a maximum cap on the mortgage, and every bank is different. Some mortgage banks, the cap goes up 2% a year, up to 5% max. Some banks are 5% max, and that's it. So, which is a big increase, but again, you're talking about a time horizon that's far out. For most people, especially people that are buying starter homes right now, which is first-time buyers, as long as they could afford it and they know that they're going to need something bigger in the future, they should go into that kind of arm. Right now is not the time to buy more home than you could afford. When the rates were in the 2s, people tended to buy a little bit extra because they could afford it and it was cheap, right? Right now, when the rates are higher, and they're the highest since they were in 2002, as of last reports, you buy a little bit less. Mm-hmm. You'll buy a starter home. If you were looking for that semi, hey, guess what? Tough times, you go into the townhouse. If you were looking for the detached, you go into the semi. Mm-hmm. You go down a little bit, you get into the house relatively affordably, and then eventually, when things improve, you refinance, you upgrade, then you make the second move. It's okay to take baby steps. You don't have to go from renting an apartment to a Center Hall Colonial.
Yeah, of course. Basically, people have to sacrifice and be patient right now. So you mentioned before that sellers might be able to pay off the buyer's closing costs. Can you tell me more about that?
Sure. So the market, like I said, changed. It's the buyer's market. So buyers can negotiate. What that means is you can negotiate the price, but you could also negotiate the terms of the deal. Okay. So terms of the deal means if you need to close in a longer time span, you could try that. But more recently, a lot of buyers, what they're doing, especially the ones that don't have a lot of cash up front to buy a piece of property, is they're negotiating to include the closing costs in the price. That's called a seller's concession. That's where the seller, included in the price, absorbs a portion or all of your closing costs. So we have buyers that are going into a house that don't have a lot of cash right now, but have a sizable income. This is really for people that are high income earners that maybe just started, or people that just recently got a really strong raise and haven't had the ability to save up a big down payment plus closing costs. Because New York, our market is unique. we have some of the highest closing costs in the country. Not sometimes, often, the closing costs are higher than the minimum down payments required for mortgages.
All right, well, that's crazy.
But that's what it is. So if you could help absorb that, you could get a mortgage with the minimum down payment, which FHA is 3.5% down. Conventional for first-time home buyers is 3% down. Mm-hmm. So by doing that, you could literally get into the house with that 3 or 3.5% down threshold and have all your closing costs absorbed, at least on an FHA loan.
Okay, and we're talking about a seller's concession.
A seller's concession,
so
correct.
Purchase price basically would look like it's up in the contract, right? Like
So let me give you a simple example. Yeah. Let's say you have a house that's $500,000, right? And let's say the closing costs are 5%, which is $25,000. Okay, and if the seller is asking $530,000 for the house, you can very easily negotiate them down. And let's say you settle on a $500,000 price. Mm-hmm. Great, you get the house for $500,000, but you still have to put the down payment, which let's say the 3% down is $15,000, mm-hmm. plus closing costs, which is let's say $25,000. That's a lot of money for most consumers to put together. I mean, $40,000 is a big chunk of change. Mm-hmm. Where let's say you have the same situation on an FHA buyer, somebody's looking to buy that house, they'll negotiate a deal where it's $525,000, and that'll include a $25,000 concession towards closing costs. Now all they have to do is put that 3.5% down of the total price, and they get into the house. So you're talking about somebody getting into the house with $20,000 out of pocket. As long as they could afford the monthly payment, mm-hmm. that's great. They got into a house, little down, and guess what? The payment will go down if and when they refinance.
And if anybody has more questions about seller's concessions, you could always reach out. I'm going to put his information down in the description below. And you can always reach out to me or Felix, and he'll explain it to you better, just so you have an idea of what can come out of your own pockets when you purchase a house. Another thing I wanted to bring up, because I know like a few months ago, I met with you, I met with an appraiser, and you know, a lot of you guys weren't seeing the market going down yet. It didn't hit you guys yet, but it hit the real estate agents already back then. So now we're almost at the end of October, and I just wanted to ask you, do you see a difference now in business?
Absolutely. I mean, refinance volumes are dead. People are not refinancing because the ability to save money on a refinance almost doesn't exist at the moment. Most people are paying a lower rate than market. Mm-hmm. However, we're still seeing some refinances for people that wanted to cash out, especially with values starting to come down. They want to capitalize on that opportunity, take some cash out, pay off debt, stuff like that. So that market's still there, mm-hmm. albeit significantly lower than it was before when the rates were in the twos. And the purchase market did slow down because a lot of people were going on the sidelines because they just can't afford the new payments and the mortgage rates. Unfortunately, when the rates move up this high, you have the people, especially on the lower level of the income scale, they're affected the most because they don't have that much discretionary income. So for them, every dollar counts. And unfortunately, they're now no longer buyers, they're renters at the moment. Mm-hmm. That will come back, but that's really affected business.
Of course, yeah.
With that said, a lot of my investors are still buying, believe it or not, because they understand that rates are transitional. And the prices, if they could get a deal, they're buying. So we do see a lot more intake of investors. When I mean investors, I don't mean flippers, because there's not opportunity or minimal opportunity mm-hmm. for a flipper right now. But people that are buying real estate, holding real estate, and renting it, we are seeing them get deals, and they're negotiating. So that's why they're getting deals.
And I think it's a great idea to invest too, because you'll have rental income, extra income coming in. And the rental market right now prices are going up. So,
I mean, with inflation at almost 10%, I mean, you either keep it in the bank or you put it into something. And real estate is a tangible asset. While it may go down, you're not buying it for the value of the real estate. You're buying it for the cash flow on the property. Yep. So as long as you're covering your mortgage and then some, my investors are happy because it gives them something that they have that's tangible.
Yeah.
Stock. You buy a stock, it goes up, it goes down. I was looking at my portfolio. I bought Netflix in the end of 2021. I think it was like $600-something a share. Now it's $200-something a share.
Yeah.
So, listen, it's every investor has their own risk appetite, but a lot of my investors do see the real estate market as something that's a little bit more of a safe haven.
Yeah, and I met some investors, and even like this big builder and everybody talks great about you. So it's, I guess you help them out a lot with the investment parts. Like, you know exactly what you're talking
Absolutely.
about, and that's why I feel comfortable talking to you as well, because you really do know what you're talking about. You and Steve. So
I think I know the builder you're referring to, but I had a similar conversation with that builder, by the way, because a lot of builders are worried, especially the ones that are building expensive homes.
Okay.
So expensive homes that are really apt for rate fluctuations. On a $400,000 home, if the rate goes up, the payment difference isn't as significant. On $1 million home, it's quite significant. So if they're building multi-family properties, two-family properties, a lot of them are thinking, hey, the market's cooling off. Let's maybe turn it into a rental portfolio instead for now while the market recovers and then sell it. But if builders are willing to now become landlords, maybe it's a good opportunity for a landlord to continue becoming a landlord.
True. That's a good point. Other than that, do you, in the future, it's hard for all of us to predict what's going to happen, right? But we do know the Fed has to raise the rates more in order to tame inflation. So do you see the rates going up any further than what they are now?
Absolutely. The Fed has blatantly said it. Rates will be increasing. So rates are going to continue to rise. And what that's just like supply and demand, as rates continue to rise, property values will eventually be curtailed with those rate increases. You can never pick the bottom, though. I have no idea. If I had that kind of 20/20 hindsight, I wouldn't be here with you. I'd be on my private island. But with that said, rates will continue to rise in the near future. As they rise, any type of asset, real estate, anything else will decline with that increase. Vice versa, when they start to come down, it'll go back up. As a buyer, if you could find the right opportunity, you should take it, because when there's an opportunity and it's in front of you, you're not going to have a second shot at it. And that's kind of the thing about what a lot of people are saying. People with money and that are investors buy the asset at the right price. You could always finance it later at the right number that you need it to be, as long as you could afford it for now. Don't overextend, but if you still have discretionary income, discretionary money, it's a good opportunity for you to build on that.
Okay. And I forgot to ask you about the when we were talking about the adjustable rate mortgages, the 5-year ARM, 10-year ARM. Is there a certain down payment that's like a minimum down payment that people need?
So it depends on the lender. Fannie Mae, you could also do ARMs. They're not pricing that much more aggressively on ARMs as they are on 30-year fixed, because Fannie Mae is government-based. But those would be the 3% down or 5% down government-based agency programs. For portfolio banks, which are banks that are lending their own money, which are the local community banks right now that are the price leaders on these products, they do have a minimum down payment. So one of my lenders has a minimum down payment that's similar to Fannie Mae for first-time home buyers.
Okay.
So for first-time home buyers, they will let you get into the property 3% down, up to a $750 loan.
Oh, okay.
Yeah. So they'll let you do the 3% down with reduced ARM rates and stuff like that. But for a typical buyer that's buying a primary residence that's not a first-time home buyer, minimum down payment is 10%. Investors also, they're probably going to need about 30% down, which is a little bit more than Fannie Mae requires.
Wow. Yeah, the investors, that's the crazy part. Like that. It's usually 25, but they're asking for 30.
They're asking for 30.
The market, or is it because?
Well, they're always a little bit more risk adverse because they're lending their own money, and historically, properties that your kids live in, you're paying the bills on that one, right? The property that you rented out and your tenants stop paying, you obviously want to pay the bills on it, but if you can't, which one are you going to choose first, right? Yeah. You're obviously going to let the investment property go. So historically, those perform worse than primary residences. Since the risk is higher, they want to cushion that risk with more equity. Even Fannie Mae and Freddie Mac, they require on a 2-family, 3-family, 4-family, 25% down, typically. So the risk appetite shows that, especially in the market now where prices are expected to decline a little bit. The banks are being a little bit more cautious, but hey, you're getting a great deal for it compared to the other market rates.
True. So I also want to bring up the buyers today. Do you have any tips, advice for any of them on what they should do?
Absolutely. And real estate agents are probably going to hate me for this. Sorry, guys. If I was a buyer in this market, right, I wouldn't find the perfect house. I would find homes that I like, Let's say you go out, you see 10 homes, right? Out of those 10 homes, there's 4 or 5 that you like. At that point, you would negotiate on 4 or 5 homes at once. You would literally make offers on all of them at a discount. Okay, so let's say you have a house that's $650,000. It's been sitting on the market for a while. You might try to do a 10% discount. See what happens. Worst thing, they say no. But if you hit 6 of them or 5 of them at once, you might have a bite on one. And it'll be great if you have a bite on 2. Because now, like there used to be bidding wars when the rates were 2, it's kind of the first to the bottom between sellers, especially with sellers that have to.
Yeah.
And that's going to be an opportunity for you to buy. As long as you're comfortable with all the houses, they're in the right school district, they meet your needs, bedroom count, bathroom count, they're in decent condition. As long as you're not picky, you could get a house for the right price. And so that's what I would do as a buyer in this market. I would not be married to one house. Like everybody was like, oh, I have to find the perfect house.
Yeah.
There's no such thing as a perfect house. So right now, when sellers, especially those that need to sell, are willing to come down on price, now that's kind of where you treat real estate like a commodity a little bit.
Yeah.
As long as it hits your boxes, you try to, I wouldn't say lowball because you're wasting everybody's time, but you try to find a discount that you're comfortable with because that'll reduce your payment. And more so, that'll also help build equity when prices start to appreciate again, which they will eventually.
They will eventually, I believe that. But I do, I believed like a few months ago that prices were going to go down like 10, even up to 20%. But I feel like with the rates going up as high as they are right now, and the payments are like from when they were in the 3s to what they are now, people are paying like double than what they would have paid, right? When the rate
I wouldn't say double, but it is significant.
Yeah.
It is significant. But Jimmy, you're being a little bit too glum about this.
Yeah.
Listen, I hear you. People still have money. Remember, we're skewed on the market. The average consumer is not a home buyer.
Okay.
The average person can't necessarily afford to buy a home by themselves, right? The population that we see are home buyers. So you have all those renters that make decent income, that have a family, are able to live in New York City fine, that aren't part of our population. And so you have population bias inadvertently. And so the people that are consumers on our end that are viable for our market, yes, will it knock out the bottom 30%? Absolutely. But there's still people that were looking at homes that are under their budget. And they have the ability and are willing to spend a little bit more. It's a smaller percentage of people, but there's still plenty of qualified individuals out there that are looking for real estate. Because guess what? What's your alternative? You still need a place to live. You need a place to raise your kids, have a family, have a life, right? You could be a renter, and being a renter, there's nothing wrong with that, right? But for the people that have the ability to, and they want to own their own home, they still have the opportunity. Just like the people that are buying Starbucks coffee versus going for Walmart and getting store brand.
Yeah.
Right? There's a consumer for everything. So we always have a skewed perception and everything. Yes, the bottom end of the potential buyers got knocked off in their renters. But there's still the significant portion, and I would say the majority, that still can buy. And those buyers, like I said, they're willing to buy a little bit less. And they're willing to negotiate. They're smarter, savvier buyers that now have the ability to perform in this market.
Okay. Well, the question I was going to ask was, since I do think prices are going down by 10, 20%, do you see them going down further?
I don't know. I can't tell you how far prices are going to go. I do know in the market that we're in, New York, fortunately, has been very insulated in the past. Even in 2008, where other markets like Florida, Nevada, the Sun Belt state got crushed, like they got decimated in 2008. So when that happened, Florida was relatively crushed compared to New York. New York was almost unscathed. We did see price decreases in New York. Off the top of my head, I would probably put a number of about 15%, maybe 20 tops. Okay. But that's just an anecdotal statistic. However, I do see prices coming down. Have prices come down from their peaks? Yes, just like the stock market, it came down from its peaks, right? I do see that real estate is a little bit more static than stocks, right? Sellers can't afford to sell under a certain amount because they have mortgages. Buyers will eventually come to an equilibrium with the prices. You had sellers that were just simply overpriced. And buyers desperate in need of a home because supply was short were willing to pay it when the rates were in the twos.
Yep.
Now that the rates are no longer there, sellers can't be overpriced. If you're a seller in this market, you need to price right.
Yeah.
Because if your house sits in the market, if you don't sell it within the first 3 weeks, you're going to end up selling it probably for 15% lower than you would have sold it if you priced it right.
That's exactly right.
And so as long as you have an adequate agent that knows the market, prices it right, there still will be a sale. If you're priced high, good luck. But you know what? That's a great opportunity for a buyer because that buyer will end up getting deals. And if you get a deal, yes, property values will probably come down in the short term. Eventually, that'll turn around. As long as you're comfortable, you get a home, you don't have to deal with bidding wars, you don't have to deal with waiving contingencies, waiving inspections. You know how many buyers didn't do an inspection and now they have problems in their house?
Yep.
Heck, I'm one of them.
Yeah, it's true.
I bought a new construction and I didn't do an inspection because I didn't know you needed one for a new construction. Yeah. And lo and behold, I have a plumbing issue. They have to redo some of the plumbing in my house. Oh, wow. Luckily, I'm a new construction, so I have a warranty. But other buyers that have to eat that. That's a $40,000 job.
It's a big job for
That's pipes, a big job. You have to completely gut a basement, redo concrete, put new pipes, refinish. It's terrible.
Wow.
But that's the market of the past. The market of the current, and you can never time it. The market of the current is you're able to get into it. You're able to negotiate a fair price. You could even get a deal, especially in situations where sellers have to sell. And that's really important. If a seller needs to move because they're being relocated for a job, a divorce situation, unfortunately, or a death in the family, those are situations that people have to sell. A lot of older sellers are downsizing right now. They can't maintain the property. So they're willing to go from $1 million house to a $300,000 condo. If they get, instead of $1 million, if they get $950 for their house, they're still fine because they need to do it. And that's what the market dictates. I'm not saying take advantage of the seller. I'm not saying that. Right now, the market has shifted into a buyer's market, so you just have the ability to take advantage of the market to negotiate a fair deal for everybody. And what is a fair deal? Where everybody's a little bit unhappy.
Yeah, true. And then the last thing I wanted to ask you is, are there any programs or anything like that for first-time buyers, secondary home buyers, anything like that you want to bring up?
Sure. So back to the community lenders that we work with. The big banks, big agency lenders, they don't want to touch this market. They're scared, and that's why their rates are over 7% because they're trying whatever they buy in a normal price range, unless it's super jumbo or expensive, they sell to Fannie Mae and Freddie Mac. And
I'm sorry, I just want to get this right. So the bigger banks, you're saying that they sell their loans to Fannie Mae and Freddie Mac?
So most big institutional lenders, including the big boys, the ones that you see on every corner, right?
Yep.
For any loan under the conforming limit, which right now is in the mid sixes, it's going to probably go up to 700 after New Year's. So anything under that for a one-family property, it's a conventional conforming loan, which they package and sell to the agencies, Fannie Mae and Freddie Mac. Anything above that is considered jumbo, so they will keep that on their books. They, on the lower end stuff, the smaller loans, they are giving conventional conforming rates, which you saw today on Mortgage News Daily, which is a third party, is over 7%.
Yeah.
Okay? Those loans will get those rates. Bigger loans, especially if you have a relationship with those banks, they'll give a significant discount to that, which is unfortunate because the people that need the discount are the first-time home buyers. They do have certain programs for them, but the community banks are really where are special in this field right now because especially with their CRA incentives, which is the Community Reinvestment Act, you could get a first-time home buyer. Like one of my banks in New York City metro area, in Long Island, the income limits are even higher. But in New York City, if you make under $128,000, they will give you a reduced rate and a credit towards your closing cost.
That's pretty good. What's the credit?
So if it's under $128,000, they'll give you $2,000 off your closing cost. If you make even less than that, let's say you make under 70, then they'll give you even more. They'll give you $7,000 off your closing cost.
So they actually want to give loans out.
They want to give loans. And the reason the community banks are leading this is, think about it logically. They're small, right? So when all the loans that refinanced, when the rates were in the twos, they lost a huge portion of their portfolio. Everybody refinanced, right? They now are sitting on a ton of cash, and cash is not doing anything for them. So they want to lend. They're smaller, and they don't have the footprint of a lot of the larger lenders. Mm-hmm. So how do they get customers? They have to incentivize it with a little bit of a better deal. And that's what they do.
And do they have any limitations on, I'm sure they do, but any restrictions, or is there a minimum of like an income of somebody should have, a minimum credit score?
Well, similar to normal loans, you have to qualify. You have to be credit worthy. So you have to have decent credit. You have to have different lines of credit and trade lines. You have to have income to qualify. It's similar to the regular conforming Fannie Mae, Freddie Mac loans. Okay. The difference is they have cheaper rates.
Okay, and these are like new programs that you're saying that just came
No, they've always been there, honestly. Okay. The problem is when the rates were in the twos, because they lend their own money, it's portfolio money, they never dropped their rates that low.
Okay.
So they were never as important as they are now. So that's why, as a broker, I work with 50 banks. Before, I used to send a few off loans to these lenders. Right now, I'm sending a big portion of my loans to these lenders because they're price leaders.
Sure.
And I have to do what's best for the customer. Yeah. And so if there's opportunity out there, which there is, customers should jump on it.
That's very good. Very good. Well, I don't know. Do you have anything else like you wanted to talk about before we end this beautiful interview?
A lot of people are dreary of this market. A lot of people are saying real estate's going to crash. It's getting scary out there. It is. Just like every market where things are turbulent. When COVID first happened, how many times did you hear, oh, New York's dead? Forget it. New York City, everybody's moving out. It's dead. Mm-hmm. Rental prices in New York are the highest they've ever been. Real estate in New York City is the highest it's ever been. Real estate in New York, even the suburbs, is still at levels that are the highest they've ever been. Mm-hmm. Yes, they're coming back down. They're coming a little bit down to reality. And I can't tell you the percentage, but they are coming down. Okay? It's an opportunity for a smart consumer to get in when everybody's running away scared. Okay? There's going to be an uptick eventually. The United States government can't afford to have real estate crash across the board and not do anything about it to prop it up, just like they did in 2008. Eventually, they're going to have to stop that flow. Things are going to recover, and just like now, the prices now are significantly higher than they were in 2008. Oh, yeah. That eventuality will happen. You have to get on board. You have to pick your time and get on board.
Very good. Well, thank you very much, Feliks. Anybody needs to ask Feliks a question or me, I'm going to have all the information down below in the description box. Don't forget to follow, like, and subscribe. Thank you very much. And thank you.
Thanks guys for having me. Thank you, Jimmy. It's been a pleasure.
Anytime. Always a pleasure.